RGTI is one of those quantum stocks where the story sounds obvious until you look at the math. Rigetti builds real superconducting quantum computers. It runs its own Fab 1 manufacturing facility. It sells systems, components, services, and cloud access. But at the June 10th research snapshot, the market value was about $6.5 billion, while Q1 revenue was only $4.4 million. That is roughly 370 times annualized Q1 revenue. And the $100 million government funding headline may help the roadmap, but it may also bring share issuance. So this is not a simple quantum is fake story. It is also not a simple government funding means the stock wins story. The real question is whether Rigetti can turn serious science into serious revenue before the valuation gets tired of waiting. That is the proof gate. Start with the business. Rigetti is a superconducting quantum hardware company. For this video, you do not need a full physics lecture. You only need the stock market version. A normal computer uses bits. A quantum computer uses qubits. Quantum systems may eventually help with certain problems in chemistry, materials, simulation, optimization, cryptography, and research. But eventually is the expensive word. Investors can pay for eventual success long before customers pay for it at scale. Rigetti's specific approach uses engineered superconducting circuits that have to be controlled at extremely cold temperatures. That approach is serious. It also comes with a heavy engineering burden. Processors, control electronics, cryogenic systems, software access, customer support, and manufacturing discipline all have to work together. That is what makes Rigetti different from a light software wrapper. If the hardware path works, the upside can be much larger. If it does not convert into repeatable demand, the costs can stay ahead of the revenue for a long time. So how does Rigetti make money today? This is where the story gets much more useful than a normal quantum headline. The Q1 filing breaks revenue into 3 lanes. Lane 1 is sales of quantum computers and quantum components. That was about $3.0 million in Q1. This is the hardware lane, Novera systems, quantum processing units, and larger on-premises quantum computer opportunities. Lane 2 is collaborative research and professional services. That was about $1.3 million in Q1. This is the work for customer lane. Development contracts, research support, technical services, and custom work that can help customers move closer to using quantum systems. Lane 3 is access to quantum computing systems. That was $55,000 in Q1. Not 55 million, 55,000. That tiny line is one of the most important details in the whole video. When people hear quantum cloud, they may imagine a giant software-style subscription engine humming in the background. In Q1, that was not the business. The cloud access line was closer to a footnote than a flywheel. The money came mostly from hardware and components, plus services and research work. That does not make the cloud platform irrelevant. Cloud access can still be strategically important because it lets researchers, developers, and institutions try the machines. But if you are trying to understand the company, do not picture Rigetti as a normal software subscription business. Today, it is much closer to a deep tech hardware and R&D business trying to turn specialized systems into repeatable demand. That distinction matters because hardware revenue can be lumpy. A system delivery can make a quarter look strong. A quiet delivery period can make revenue look weak. The filing says revenue may fluctuate significantly because sales, development contracts, and cloud access vary in timing and size. So when someone says revenue was up almost 200%, the right response is not to ignore it. The right response is to ask what drove it. Was it a repeatable usage engine? Was it a few system deliveries? Was it development work? And did the gross profit and operating loss improve in a way that shows the business is getting healthier? Now look at the technical proof point that bulls care about. Rigetti reported that its Cepheus 1108Q system became generally available through Rigetti QCS, Amazon Bracket, Microsoft Azure Quantum, and QBraid. This is a 108 qubit system. The company says it is built from 12 interconnected 9-qubit chiplets. That chiplet idea is central to the Rigetti story. Instead of building one giant monolithic quantum processor all at once, the company is trying to connect smaller quantum chiplets into larger systems. For a beginner, think of it like building a city from neighborhoods. One neighborhood can work by itself. But the real test is whether roads, power, communication, and traffic control still work when all the neighborhoods are connected. Quantum chiplets have a similar investor lesson. A 9-qubit building block is not enough by itself. The question is whether Rigetti can connect more blocks while preserving quality and control. That is why fidelity matters. Fidelity is a measure of how accurately quantum operations are performed. If fidelity is too low, errors pile up. If errors pile up, useful computation gets harder. Rigetti reported median 2-qubit gate fidelity of 99.8% on a 9-qubit system, and prototype results as high as 99.9%. Important, that is not the same thing as saying the full deployed 108-qubit system is already operating at 99.8 or 99.9% 2-qubit fidelity. Rigetti's April 108-qubit availability release described Cepheus 108Q at 99.1%, median 2-qubit gate fidelity. That distinction matters. The best small system or prototype number is not automatically the full large system number. The business question is whether Rigetti can scale the quality, not just show a better number in a smaller configuration. That is technical language, but the investor translation is simple. Rigetti is trying to show that its system is not only getting bigger, it is trying to keep the operations reliable enough as it scales. That is the right kind of technical progress. But a quantum stock is not only a science exam, it is also a business exam, a cash flow exam, and a per share value exam. This is where the May 21st funding headline becomes important. S government for a proposed award of up to $100 million over 3 years. The Department of Commerce and NIST placed that inside a broader quantum effort involving multiple companies. For Rigetti, the proposed support targets superconducting scaling bottlenecks, readout electronics, and next-generation cryostat architecture. That is why the headline matters. It is not generic subsidy language. It points at the same engineering problems Rigetti has to solve if its chiplet roadmap is going to matter. So yes, the headline is a positive signal, but the lazy read is to treat it as pure upside. The filed 8K is more complicated. The contemplated award includes a proposed government equity stake through common stock. The exact number of shares would depend on final investment amounts and a formula tied to market prices. The preliminary terms also describe a 15% discount to a reference price based on the lower closing prices around the signing and disbursement dates. That sentence is not as exciting as $100 million, but it is where shareholder math lives. That makes the funding headline a two-sided event. It can extend runway and validate the roadmap. It can also add share count math that investors need to understand. Until final documents are signed, the LOI is a catalyst, not a completed investment case. Also, do not mix up two different $100 million stories. S Department of Commerce item is potential funding support. Rigetti also announced an intention to invest up to $100 million in the United Kingdom over several years as part of a plan to develop and deploy a future 1,000-plus qubit system. One is possible government support. The other is Rigetti planning to spend money to expand. Same dollar headline. Very different shareholder meaning. Now move to the financial reality check. The three numbers tell the whole quarter: $4.4 million of revenue, $26 million of operating loss, $33.1 million of GAAP net income. One shows business size, one shows burn, one shows accounting noise. That is the quarter in miniature. Start with revenue. Rigetti's Q1 revenue was $4.4 million. That was up sharply from $1.5 million a year earlier. So yes, revenue grew, but now you know what was underneath it, mostly hardware and components plus services and research work with only a tiny amount from system access. That is not the revenue shape of a mature cloud platform. It is the revenue shape of an early hardware company still proving which commercial lanes can scale. Now, look at gross profit. Rigetti reported about $1.4 million of gross profit in Q1. That means the company did generate profit after direct cost of revenue. But gross profit is not the finish line. Operating expenses were much larger. Research and development expense was about $20 million. Selling, general, and administrative expense was about $7.4 million. Put those together, and the operating loss was about $26 million. So the company is not operationally profitable. It is still funding a large research and engineering organization on a small revenue base. That is the key P and L shape. Some gross profit, large R and D, large operating loss, strong cash runway, still unproven operating leverage. This is the financial health story in plain English. Rigetti is not in immediate balance sheet distress, but the business model is not self-funding yet. The balance sheet gives time. The income statement still demands proof. The base is also extremely small compared with the public market value. This is beginner trap number one, confusing percentage growth with scale. If a company grows from $1.5 million to $4.4 million, the percentage increase looks huge. But $4.4 million of quarterly revenue is still tiny for a company with a multi-billion-dollar market value. That does not automatically make the stock wrong. Early technology winners often look expensive before the financials catch up, but it means investors are paying mostly for future proof, not current proof. That $26 million operating loss was roughly 6 times quarterly revenue. That is the core financial tension. The company has serious technology and a serious roadmap, but it is still spending far more to build the platform than it is currently generating in revenue. Again, that does not automatically kill the thesis. Deep technology companies often lose money for years. The question is whether the losses are buying progress that later turns into larger revenue, better margins, and more durable customer demand. That difference matters. Now let us talk about the most misleading number in the quarter. Rigetti reported GAAP net income of $33.1 million. If you are new to investing, that sounds like the company suddenly became profitable, but this is exactly where you have to slow down. The filing shows a large gain from the change in fair value of warrant liabilities. That accounting gain was about $53.7 million in Q1. In plain English, the net income line was helped by a non-operating accounting movement. It does not mean the core quantum computing business was suddenly printing cash. Rigetti itself also reported non-GAAP net loss of $14.7 million. So the beginner lesson is simple. Do not stop at the net income headline. For this company, the operating loss, cash burn, revenue scale, and balance sheet tell you more about the business trajectory than the GAAP profit headline alone. This is beginner trap number 2, confusing accounting profit with operating proof. Now the good news, Rigetti's balance sheet is not weak. The company reported $569 million of cash equivalents, and available for sale investments at March 31st, 2026. It also reported no debt. That is a major advantage for a company still trying to prove a hard technology market. Cash is time. It gives Rigetti time to build systems, improve fidelity, invest in control electronics, support customer deployments, and absorb losses while the market develops. But cash is not proof. A long runway is useful only if the company uses that runway to reduce the distance between the science story and the business story. In Q1, the filing shows net cash used in operating activities of about $16.2 million. Capital expenditures were about $4.4 million. That means investors should watch not only the income statement, but also cash flow and capital intensity. It likely does. Now, we need to talk about dilution. This is the financial test many retail investors skip. Rigetti had more than 332 million shares outstanding as of May 8th, 2026. The company also has warrants in the capital structure, and the proposed government award terms contemplate a common stock equity stake if final terms are reached. That means the shareholder math can change. When a company is early, unprofitable, and capital intensive, share count matters. If the business becomes much more valuable, dilution may still be worth it. But if the stock price rises mostly because of themes, headlines, and future expectations, then additional equity issuance can quietly move value away from existing shareholders. That is why the government funding must be analyzed as both a catalyst and a capital structure event. Now shift from financial proof to customer proof. Cloud access is useful. It lets developers and researchers try the system. It can expand reach. It can lower friction. But access is not the same thing as demand. A system can be available on a platform and still not generate meaningful, repeatable, high-margin revenue. For Rigetti, the company reported that Cepheus Men 1108Q became generally available through its own QCS platform and several major quantum access platforms. That is distribution evidence. The next test is usage. The test after that is paid usage, then repeat paid usage, then larger contracts, then gross margin and operating leverage. That is the customer ladder. Step 1, people can access the system. Step 2, people run meaningful workloads. Step 3, institutions pay for those workloads or systems. Step 4, customers come back or expand. Step 5, revenue grows faster than the cost of supporting the platform. Rigetti is not at step 5 yet. That does not make the story fake. It tells investors where the burden of proof sits. The company also sells on-premises systems, including Novera QPU activity. That matters because on-premises deployments can create more visible revenue events than small cloud access usage. One concrete example is Rigetti's previously announced purchase orders totaling about $5.7 million for two 9-qubit Novera quantum computing systems, with delivery expected in the first half of 2026. Another is the announced $8.4 million purchase order to deliver a 108-qubit quantum computer to India's Center for Development of Advanced Computing. That is a more serious customer proof point than a logo on a slide. It is a specific system order. Still, one order is not a business model by itself. Small QPU sales prove interest. Full system orders prove more. Repeat orders prove demand. Revenue recognition proves execution. Expansion proves product market fit. And system sales can be lumpy. One delivery can make a quarter look stronger. A quiet quarter can make growth look weaker. That is why the next few quarters matter more than one isolated headline. If revenue grows because customers are buying systems, using cloud access and expanding real projects, the thesis improves. If revenue remains small while press releases keep highlighting technical milestones, the thesis stays speculative. Here is the hype filter. Hype says quantum computing could change the world. That may be true eventually, but it is not enough for a stock thesis. Business evidence says someone paid Rigetti for a system, a component, a development contract, a service, or quantum system access. Hype says Rigetti is available on major quantum platforms. Business evidence says those platforms are producing meaningful paid usage. Hype says a 108-qubit system sounds impressive. Business evidence says the system helps customers do something valuable enough to pay again. Hype says a government LOI is a huge vote of confidence. Business evidence says final award terms, milestones, and share issuance still work for shareholders. This is how to avoid getting lost in the quantum vocabulary. Translate every headline into one of three questions. Who pays? How often do they pay? And does the company keep more money as it scales? That last question is where the profit story lives. Now compare Rigetti's position inside the quantum race without pretending there is an easy scoreboard. IonQ, D-Wave, Quantinuum, IBM, and other quantum efforts are not all playing the same game. Some are trapped ions, some are superconducting, some lean into annealing, software, cloud access, enterprise systems, or broader technology ecosystems. That matters because best quantum stock is too vague. The better comparison is architecture by architecture and proof by proof. Who is scaling useful systems? Who is turning access into repeat usage? Who has enough capital to keep going? Who is improving technical performance without letting dilution swallow the upside? For Rigetti, the clean bull case is not that every other quantum approach fails. It is that superconducting quantum remains a major lane, and Rigetti's chiplet strategy, Fab 1, partner access, cash runway, and government support give it a credible shot inside that lane. The clean bear case is not that Rigetti has no technology. It is that good technology can still be a poor stock if revenue stays small, losses remain high, final award terms dilute more than expected, and customers do not move beyond experiments. So instead of ending with a generic checklist, here is what would actually change the view. First, revenue quality. 1 quarter of growth from a tiny base is not enough. The thesis improves if future quarters show revenue from systems, cloud access, and customer deployments that is larger, less lumpy, and easier to connect to actual demand. It weakens if revenue stays near science project scale while the market cap continues to price a much larger business. Second, loss ratio. An operating loss of about $26 million against $4.4 million of revenue shows how early the model is. The view improves if revenue rises and the operating loss becomes less extreme relative to revenue. It weakens if every new milestone requires spending that grows faster than the business. Third, cash productivity. $569 million of cash and investments is a strong starting point, but cash is useful only if it buys progress. Higher fidelity, larger systems, more paid usage, stronger margins, or a clearer path to operating leverage. Fourth, final award terms. The $100 million LOI is meaningful, but final documents need to show milestones, timing, funding mechanics, and share issuance. Good terms would make the catalyst more valuable. Weak terms would make the headline less impressive. Fifth, technical scaling. The 108-qubit system and reported fidelity improvements matter because they show the roadmap is moving. The next question is whether the chiplet approach can scale while preserving quality and producing customer value, not just bigger numbers. Sixth, per share outcomes. Early stage technology companies often need capital. Rigetti has cash today, but warrants, equity-linked awards, and future capital needs can still affect what each share actually owns. That is the framework. Revenue quality, loss ratio, cash productivity, final award terms, technical scaling, per share value. Now the bull case. The bull case is that Rigetti has one of the more credible pure play paths in superconducting quantum. It has in-house fabrication. It has a modular chiplet strategy. It has a 108-qubit system available through several access channels. It has reported fidelity progress. It has a large cash and investment base. It has no debt. It has government funding momentum. And it has partner activity that could help move the story from lab progress toward deployable systems. If those pieces reinforce each other, RGTI could become more than a theme stock. It could become a company with operating proof in a major emerging technology category. Now, the bear case is not that quantum computing is fake. The bear case is that the stock may already be pricing a lot of success before the business has proven enough. Revenue is small, losses are large, GAAP profit was not core operating profit, the funding headline has final term risk, customer demand still has to repeat and scale, and quantum advantage remains a future milestone, not a current mass market business model. The bull case starts breaking if three things happen. First, revenue stays tiny while the market keeps valuing Rigetti like a future category winner. Second, fidelity improvements do not translate into larger useful systems that customers actually pay for. Third, the government award creates dilution without enough commercial progress to offset it. That is the uncomfortable version of the story. The science can keep getting better while the stock still disappoints. That is not a prediction. It is the risk investors are being paid or not paid to take. That is why RGTI anti-lazy analysis. Do not dismiss it just because the financials are early. Do not chase it just because quantum is exciting. The right answer is not blind optimism or automatic dismissal. Here's my final view. Rigetti is a serious quantum company with technical progress and a policy catalyst. But RGTI stock still has to earn the valuation. That has not been fully proven yet. So if you follow this stock, do not only watch the next quantum headline, watch the next revenue number, watch the operating loss, watch cash used in operations, watch the final government award documents, watch the share count. Watch whether 108 qubits becomes a stepping stone to larger systems, better fidelity, and more serious customer usage. That is the difference between a quantum story and a quantum business. So the question is not whether Rigetti is serious. The question is whether the business becomes serious fast enough for the price investors are paying today. This is educational only. It is not financial advice, and it is not a buy, sell, hold, or price target recommendation. Always do your own research.